Good morning. When non-recourse isn't risk-free, the hidden risk inside commercial real estate loan documents. And non-recourse financing is one of the most misunderstood concepts in commercial real estate lending. And many investors believe that a non-recourse loan means that they can hand back the keys if the project fails and walk away without any personal liability. And in theory, that's correct. But in practice, it's conditional. And the conditions matter. In the Medallion companies, we will review your loan structures every day for commercial investors across Houston, Katy, Fulshire, and nationwide. And the difference between limited liability and full personal exposure often comes down to language buried deep in the loan documents. So let's talk about what non-recourse actually means. And a true non-recourse commercial mortgage limits the lender's recovery to the collateral, so the property itself. And if the asset underperforms, the lender can foreclose. And at that point, the borrower loses their equity. But however, the borrower is not personally liable. And that's the assumption. But embedded inside most loan documents are carve-out provisions and guarantee clauses that can override some of that protection. So let's look at the core risk, and that's the carve-out provisions. And carve-outs typically fall into two categories. So the first is above-the-line carve-outs. These limit borrower liability to the lender's actual losses. So some examples would be through fraud or misrepresentation, or through misuse of rents, or through unauthorized transfers. And here, liability is generally limited to the damages that are incurred. And two, there's below the line carve-outs, and these are the dangerous ones. These can trigger full recourse, meaning the borrower becomes personally liable for the entire loan balance. And some examples may include bankruptcy filings that were deemed in bad faith, certain litigation defense broad definitions of what's waste, or unpaid liens or service contracts satisfied by the lender. And this is where a $15 million non-recourse loan can suddenly become a $15 million personal obligation. So let's talk about how waste gets defined. And most investors think waste means physical damage to a property. And in modern loan documents, waste can extend to failure to maintain operations is the biggest catch-all, but also to deferred maintenance, to operational underperformance, and to improper tenant handling. And the drafting language determines whether operational stress becomes a recourse trigger. And since the global financial crisis, lenders have expanded these clauses, and documentation has become more protective for the lender. So let's talk about the fragmented expertise problem. And here's the simple structural issue. Real estate brokers understand property, and bankers understand the underwriting. And attorneys, they understand the contract law. But very few professionals integrate all three. And what this does is that potential gap right there is going to create blind spots. So borrowers are often ready to negotiate rate and leverage, but also ignore potential liability through exculpation clauses or recourse triggers or guarantee structures or the litigation language. And that the risk isn't discovered at closing. It's discovered when there's distress, when it's already too late. So let's give you a scenario to help paint the picture. Let's imagine it's 2018 and an investor secures a $15 million non-recourse bridge loan. And in 2025, the market softens, the NOI declines, and the refinance window is tightening. But the investor prepares to surrender the property, and then they discover that a carve-out was triggered. a covenant was violated, and that their personal liability is going to apply. And what was assumed to be a limited downside becomes a balance sheet event for them. And that's not a rate problem. That's a structure problem. So let's talk about why structure beats rate. And at Medallion Mortgage and Funds, we consistently tell investors rate is temporary and structure is permanent. And the difference between limited exposure and partial recourse is full recourse. So it's often determined before you ever close, is the point. Non-recourse protection is real, but only when the carve-outs are more narrowly drafted and guarantees are clearly limited and the covenants are realistic, and when there's a thorough legal review. So the key takeaway is that non-recourse does not automatically mean there's no personal risk involved. So between the carve-outs, your operational covenants, and guarantee triggers, liability can shift from the asset to the individual sponsor pretty quickly. Now, if you're securing commercial real estate financing, whether it's bridge or it's agency or it's bank or it's CMBS or if it's private debt, you need to understand not just the rate, but also the recourse language. Because the true risk isn't what happens when things go well, it's what happens when they don't. And if you want a second set of eyes on your structure before you close, reach out to me at billrapponline.com and you can figure out how to get a hold of me. Love to talk to you about your situation, figure out what we can do to help you. Have a good day.